Hey, good morning. Welcome to the Mortgage Rate Forecast with Scott Criss, your mortgage rates and news. It is July 13th, and let's get started with charts. A lot of movement over the last couple of weeks. Bonds have really sold off. Looks like we started to develop an upward trading channel, but don't get too excited yet. Here's where we're at. We're at 102.59 this morning. Our support's coming in below us at about 102.40 and way down here at 102. We did at least stop the bleeding from this downward trading channel over the last couple weeks. So our resistance coming in right above us at about 102.80. 102.80 is a pretty important mark today, guys. Core CPI missed expectations. CPI is inflationary factor, and inflation is a big enemy of bonds. You figure if you're an investor and you have a bond that's maybe making you 3%, but inflation's at 2%, your final yield is only really 1%. So you can kind of see how inflation plays a big role on how bonds are traded and how valuable they are. So jobless claims a little bit better than expectations. So a little mixed bag of news today. Quick note, we did have on July 11th a rollover. It impacted us about 18 cents. So where you're looking at my mouse right here, this was the rollover day. So what does that mean? It's kind of like when you own a stock. And let's say the stock, you own it, it's worth $100. And the company splits the stocks. So then once they do the split, you own two stocks now at $50. So same thing, it's just they split the stocks. Bond rollovers are something relatively similar, I guess you could say. But essentially what it really means is trading, even though it looks like where it's at, it's technically 18 cents better. So sorry, that kind of makes these charts a little tougher to understand. But the Euro shares are up. Yellen's going to continue with her testimony today. So, investors are going to be pretty closely watching her to see what she's saying. And so we may see some movement just based on that testimony. So to quantify where we're at, we were at about 103.20 on average in June. In June, Freddie Mac, and the source is down below, Freddie Mac reported the average consumer received a 3.9% interest rate and paid a half a point to get there. So if the average trading was about 103.20 last month, and now it's down to 102.59, that's 61 cents worse, meaning that if the average consumer to get that rate was paying half of a point, they may be paying a little over a point now. So let's get to our projections though. Where are we headed, guys? Well, my last projection was a hit. I'm going to actually maintain the same projection. I think we're still going to stay between 102.40 and 103. This leaves us room for improvement as much as 41 basis points, or almost a half a point. And but fees could get worse as much as almost a quarter a point. So I would say when you go back to the charts, let's go back to the charts real quick, and let me tell you why I'm looking at this. 102.40 is a pretty good level of support now. I don't think we're going to go all the way down to 102 unless there's some crazy news coming out that nobody expected. So, but what we're coming to is we're going to get pinched. Now look at this red line coming down. This is the downward trading channel. See the green line going up? That's the upward trading channel that we just began developing. Now you can see the downward trading channel is stronger. It has a much longer history of worsening trading, where the green one has really a short history. So we are going to come to kind of a pinch, and the bonds, when they come to a pinch like this, they're going to break out. Okay, so they could break out and get worse, they could break out and get better, and it's really just going to be dependent on the economic reports that are coming out. So I would say if you're a gambling man, you know what, it wouldn't be a bad idea to consider maybe locking in your rate. That's going to be the safe thing to do. I'm sorry. If you're a gambling man, don't log on the rate. Just be really careful on the market. Keep a close eye on it. Because if it breaks out, it could break out and we could regain a lot of what we lost over the last couple of weeks. If you're not a gambling man, then the safe thing would be to lock. So it's going to be a hard call. And with Yellen still going through her testimony, it could break out without any major warning. So just kind of be careful if you do decide to float. Okay, so that's it for now. I would love to hear from you. Tell us your comments down below, and everything likes to be liked, so does this video. And if it's your first time on the page and you want to kind of keep in touch with what's going on with rates, when's the best time to lock in my loan, that kind of thing. At the top right, you click on that face and that will get you subscribed. So you just get a little alert when we post new videos. And at the top right is Mortgage Bonds 101. So if none of this made sense to you and you're like, hey, I'm just trying to get a mortgage. I just want a decent rate. Like, how does this really impact me? And what do all these charts mean? Top right, Mortgage Bonds 101. Teach you all the basics you need to know when you're trying to pick out the best time to lock in your rate. Okay, guys, that is it for now. Hope you have a great weekend, and we'll be in touch next week. Take care. Bye-bye.